So in this video, I want to talk about why I sold DFN.TO. So about a month ago, I made a video right over here, 24% dividend yield, regarding the DFN.TO mutual fund, which is a mutual fund by the company Questrade. Basically, this mutual fund, how it works is it invests in these quality companies that you see here: Bank of Montreal, Bank of Nova Scotia, BCE, which is Bell, many other Canadian banks, Canadian insurance companies as well. You've got Enbridge as well. So all quality dividend paying stocks, Canadian dividend paying stocks, and they write covered calls on these positions as well. So that's how the fund works. And in return, they've got two different funds. They've got preferred shares and Class A shares. But what's great about the Class A shares is that it pays 10 cents per share per month. That's the dividend payment or dividend distribution on this fund. And the reason I talked about this and that I wanted to buy it is because they've never, since inception, this fund has never missed a dividend distribution. So I think the inception was back in 2004. You could see that they've never missed a dividend distribution. They've been paying 10 cents a share since 2004 every month. Now, I bought it about a month ago, and as soon as I bought it, they missed their first dividend ever. So that really disappointed me. I don't know if it's just my luck, but the whole point for buying this is for the dividends, because I know that there isn't much capital appreciation on this mutual fund. If I look it up, if I look at the chart here, DFN.TO, and I look, let's say, at 1 year or 3 years or 5 years, you can see that it's on a sort of weird downtrend, like a stair. It's got the shape of stairs or something. So I know that in the long run, I don't think this thing is going up. But if I can catch it at a low price, like during a crash, like 2008 or 2009, it reached $6. Or right now in 2020, when it reached, I think it reached the lowest is right over here, $3.55. So imagine if you were able to buy it at $3.55 and you're getting 10 cents a share per month. Now, right now, you wouldn't be getting it, but as soon as they start paying it, you'd be getting 10 cents a share. So if you bought it at $3.55 and you're getting 10 cents a share, that's a dividend yield per year of almost 33 or 34%. That, of course, is an amazing dividend yield. Obviously, you're not going to be getting much capital appreciation, but you're getting a crazy dividend yield. And when I bought it at $5. So that gives me a yield of about 24%. So 10 cents divided by 5 times 12 is 24% per year. But as soon as I bought it, they announced their first dividend cut, which is because of this over here, net asset value. So their net asset value, for them to pay the dividend distribution every month, the net asset value of the fund has to be above 15. So when I bought into this mutual fund, the net asset value was about 17. And when they came and posted their net asset value for the following month, it was below 15. So it dropped a lot. So what disappointed me is, yes, the market was crashing, so it is fair for the net asset value of the fund to drop. But the underlying stocks, although they dropped, of course, they're still pretty high. They didn't drop that much compared to 2008, 2009 prices. They're still higher than 2008, 2009 prices. The prices of these individual underlyings are still pretty high compared to past prices. If I look at the first one here, BMO.TO, and if we look at Max, so it's trading at 70 right now, but it was trading much lower in 2008, and the last time it was trading at 70 is around 2015. So yeah, it is trading at 2015 prices, but it's even 2015 prices is considered decent or considered high. So what disappointed me is that means for this fund to continue paying its dividends, the underlyings have to be trading above 2015 prices, which is, in this example, which is, in my opinion, not a bad price. So I find it puts a restriction on the underlying stocks. The underlying stocks always have to be performing for this fund to be paying the dividend. It cannot drop below a certain price, or else it's considered to have a low net asset value and the fund will miss its dividend distribution. So I find that the net asset value condition of $15 is a bit too strict right now, because at any time now it might drop below 15. So if the net asset value drops below 15, there's no dividend payment, and I think it could happen more than once going forward. If we look at Bank of Nova Scotia, BNS.TO, and if we look at the chart, max 54, so it was last trading at 54 at around 2016, but 2008 prices was around $28. So it's still double the price of 2009 prices, but for this fund, it's not good enough. The underlyings are not performing, and therefore the net asset value dropped below 15, so no dividend payment. So the underlyings really have to be performing for this fund to keep paying its dividends. So that disappointed me. And as you can see, I bought it for $5, and 1 month later I sold it for $5. I sold it for $5.62. And another thing that bothered me about this mutual fund is there was a day where it just jumped to $6. Here, you can see it over here. Look at this. Just one day it opened, I believe, 456. So here I'm trying to zoom in on the day. So it was March 26th, it looks like. So you could see that it opened. So this candle here really disappointed me, or surprised me. It doesn't make sense how the stock opened at around 450, and then the high of the day was around 625, and then it dropped back down to 5, and the next day it's trading below 5. So this day here makes no sense to me. I don't know what happened. Who the hell bought all these shares and then brought it back down again? So it seems like a weird behavior. It wasn't even correlated to the market. So that worries me a little bit. I don't know what's going on. Doesn't make sense. I tried to sell it actually on that day when I saw it go above $6. I put an order at $6.50, didn't go through, and then I ended up holding the stock. So then when I had a chance to sell it for a profit, I took it. I sold it around here at $5.62, and I think DFN right now is trading at, it's trading at $4.97. So it's back to my purchase price. So if I wanted to get in or get back in, I could, and I would have just confirmed a profit by selling it, and now I have an opportunity to get back in at the same price I was initially. But I'm definitely not going to get back in at this price. If I do get back in, it'll be below $4 now that I know that it has potential to reach 3.5. But the other thing is I might even consider buying the preferred shares. So instead of going for the Class A shares that pays 10 cents a share, which provides that crazy dividend yield, I could go for the preferred shares, which is safer. It pays a 4.5 cents per month per share. Generates around, it depends on what price you buy the preferred shares. Now the preferred shares usually trade at $10 all the time, but right now for some reason the preferred shares are trading at $9. So it's already lower than its regular trading price. If you look at max, as you can see, it's always a straight line trading at around $10 because it's preferred shares. Dividend always gets paid. And here, let's look at the different dividend distributions. You can see that preferred shares are always 4.5 cents, and they've been paid since 2004, never missed. Actually, they started a little bit higher, but after that, it's always been 4.5 cents. Actually, 4.3 cents. So yeah, if you get in at this price here and you're getting 4.5 cents, your yield is about 6%, as you can see here. So 6% is not great. And the thing is, it's never going to grow. So you're always going to be getting 6%, but the underlying is quite safe because you can see that it's always trading at $10. Now, the thing with this mutual fund is that it has a termination date. It's not valid forever. It's not. And the termination date is December 1st, 2024. So it's every 5 years, but they always end up renewing it for an extra 5 years. So nothing really happens on termination dates. As you can see, they've been existing since 2004. So they just keep renewing every 5 years. But what's important to know is what happens on termination date. So on termination date, if they decide to end it and not continue, if you don't sell your shares on the public market, here's what's going to happen. Based on net asset value, preferred shares are going to get $10. So if you bought this at $9, you're going to get $10. So you make money on what you get back in case they get terminated. So you'll get $10. Preferred shareholders get $10. And whatever's left goes to Class A shareholders. So if the net asset value is trading at 14, Class A shareholders will get $4. So Class A shareholders might lose depending on what price they paid for their Class A shares. Right now it's trading at $5, but net asset value is 14.3. So there's always a risk at termination date that Class A shareholders get less than what they paid for. Preferred shares, they'll get $10, but it's not even guaranteed. If net asset value is above $10, then preferred shareholders will get $10. But if net asset value is below $10, then they'll get that, whatever that net asset value is. And then Class A shareholders will get $0 in that case. And if you want to see where that's written, it's written under fund documents. And I think it's the prospectus. I think it's over here. If you click this one here, the last one, you could see it's written here. So this is old. It's not updated, but it's the same idea. So the date here is 2009, but just replace it by the current termination date. So it says here the preferred shares and the Class A shares will be redeemed by the company on December 1st, 2009. The redemption price for each preferred share redeemed on that date will be equal to the lesser of $10 and the net asset value of the company on that date. So if the net asset value of that company is 15 on termination date, the lesser would be $10. So preferred shareholders would get $10. The redemption, but if the net asset value is below $10, let's say it's $8, then preferred shareholders will get $8 because it's lesser than 10. Now the redemption price for each Class A shares redeemed on that date will be equal to the greater of the net asset value per unit on that date minus $10 and zero. So if net asset value on that date is 12, 12 minus 10 is 2. 2 is greater than 0, so redemption will be for $2. If net asset value is 18, 18 minus 10 is 8. 8 is greater than 0, so redemption will be $8. If net asset value is 8, for example, 8 minus 10 is negative 2. Negative 2 is smaller than 0, so 0 is greater than negative 2, so redemption will be for 0. So there's always a risk that you get less than what you paid for in case they get terminated. It's a very small risk. It's unlikely, but it's still a possibility. So preferred shares might be safer in terms of redemption in case they get terminated. But if you look at the past, they've always been renewing and they've always been paying a dividend. It just happened that this month was the first time ever that they missed their dividend distribution. But regardless, I got out for that reason. And if I wanted to get into dividends, although the 24% yield is very tempting, I mean, you just buy it once, don't touch it, and just keep getting 10 cents a share or 24% a year. And even if they miss a few months, you'll still be at 20% or 18% per year yield. So it's still amazing. But if I go back to the fund features, I think if I want to get into dividends, I could just pick one stock here that I like, for example, TD, and just invest in TD. So if I look up TD.TO, right now it pays a yield of 5.8%, so it's no 24%. But at least with this stock, I've got capital appreciation. I've got potential for capital appreciation. If you look at in the past 20 years, it's always going up gradually. But not only that, I've got potential of dividend increases. So right now, my yield is 5.8%, or my dividend is 79 cents per share. But year after year, that 79-cent increases. About on average, I think 10%, 6 to 10% per year is the rate increase of the dividend. So after 10 years, I could end up with a 12% or an 11% yield on my original cost. So if we look at dividends, maybe in the past 5 years, you can see that dividend right now is about 79 cents, but 5 years ago, dividend was 51 cents. So dividend increases year after year. So that could be maybe better for the future if I want to invest for dividends instead of buying a DFN or a mutual fund that gives me a fixed amount of dividend only if net asset value is above 15. So if TD falls, I'm still getting my dividend and dividend will still increase. But if DFN falls, I might not get my dividend. So that's just my opinion. I just wanted to share why I sold DFN. Let me know what you think in the comments below, if you own it, if you're still keeping it, and what are your thoughts. And like always, if you're going to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.